Smokes, a bank just dropped 35% the same day the SPY is falling, folks. The banking crisis might be coming back. We might be gearing up for banking crisis 2.0. I want to tell you what's going on here. New York Community Bank Corp, which owns, surprise, surprise, New York Community Bank, and Flagstar, that's a big one. They are dropping to levels roughly in line with what we saw during the last banking crisis. Jump on over here. What do we have? We have 2023 going into March. Banking crisis begins. Bank stocks plummet, including New York Community Bank, down to the lower sixes, as low as $5.54, bobbing around in that $6 range for a while. After the Federal Reserve's bailout, taxpayer-backed bailout, mind you, the Bank Term Funding Program helped prop up bank stocks until, of course, oh wait, the bailout wasn't enough. What happened? Well, the bank cut its dividend down to 5 cents and took larger losses than expected. What the heck is going on here? Well, let's get into the specifics and then talk about how this affects the Federal Reserve. Let's start by looking at their quarterly income. Now, it's very important that we look at their quarterly income. Why? Because this company actually acquired a lot of these signature bank assets. So when you go back to last year, a lot of their income looks higher because you have two banks worth of income included in it. So of course their income is going to be higher. But if you look at the quarter to quarter, you can see the real picture of what's going on, of how the two banks together are operating. And let me tell you, it's not good. In fact, net interest income was down 16% quarter over quarter. Folks, if your net income, your net interest income in a high interest rate environment is going from 882 million to 740 in a quarter, it's worth noting if you annualize that, more than half of your net interest revenue would be gone in a year, 64%. That's very bad. And their total losses moved to $252 million from a gain of 207. Now, a lot of that was due to the bank taking substantially larger credit losses than expected. Markets were looking at a $45 million allowance for credit losses, basically loans going bad. They actually took a $552 million write-down of future loans that could go bad. In other words, they're like, we're giving up on 12x what the market thought. So in other words, the bank itself is like, yeah, this is a lot worse than we thought. Sorry, we're going to cut the dividend because these loans are not performing or may soon not be performing. Yikes. Now, they do give a description on this, and they also somewhat, I hate saying this, but try to mislead their audience or their investors in two different ways. The number one way they like to mislead is you have to look really carefully at this. This is a deposit flow analysis, and when you look at this chart at a glance, and I understand this is an investor's mistake if they're just looking at a glance, but at a glance, it doesn't look like the deposit bar chart is that different. But the way they've set this up is really hiding the fact that they had a $1.3 billion outflow. The chart is somewhat rigged to make that $1.3 billion outflow in the quarter not look that bad. And for a bank that has about $11 billion in cash, $9 billion in short-term assets, so about $20 billion available for outflows, but all of that is financed likely by a wholesale line of credit that they have, which basically means if you pay off the wholesale line of credit, the debt they have, you don't have any cash available for withdrawals, and you're losing deposits at an annual rate of $5.2 billion, right? 1.3 times 4. That doesn't look good, especially when your stock's down 35% and you're cutting your dividend, which will probably accelerate the rate of deposit outflows. Not good at all. Scary. But that's just one way they try to mislead folks. The second way they try to mislead investors is they show this chart here, net charge-offs on average loans. So they're basically, I'll hide myself here, they're basically trying to say, hey, look how low our charge-offs are on our loans. Most of our loans are good. That's fine. But they're not telling you that most loans are small loans. Very few big loans need to go bad. In fact, guess how many loans went bad or that they started really charging off? Like, there's provision for credit losses, which is we might write this off completely. and we're going to write it off completely for right now. We might take a loss on that. They might not. You know, JP Morgan took like massive charge-offs back during COVID, and then they added that back in as income when those loans didn't default because the Federal Reserve and Congress basically bailed out people's loans, right? So you could take the loss and not actually realize the loss. Here, they're taking the loss and they're telling you, hey, we think $552 million worth of loans are going to go bad, but we're also going to identify 2 specific loans that we're just going to go ahead and charge off. That is, we're going to assume we'll never get it back. Take a look at this. Fourth quarter net charge-offs were primarily related to 2 loans. Folks, 2 loans exploded their net charge-offs, or the bulk of their $185 million in net charge-offs just in the quarter. Just 2 loans. One that was a co-op loan with a unique feature. Oh God, when have we heard that before? That pre-funded CapEx. The borrower was not in default, but we moved it to available for sale and took the write-off. Interesting. So nobody else wants to buy the loan. Why? Are they about to be in default? I mean, I hate to sound jaded here, but this is scary. This isn't good. And I'll tell you why this is scary practically. Second, we had an additional charge off of an office loan. Whatever. That's not a surprise. The problem is they're telling you, oh, look, our deposits. See, the bar charts are close to good. We're good. And then, oh, look how few loans are bad. Look, we're good. You know, they're doing all the fugazi, while at the same time, basically, the only cash they have is financed on their line of credit. Okay? After that, their deposit outflow after dropping 35%, their stock dropping 35%, is probably going to skyrocket. They are now literally at banking crisis levels. And guess what? The Fed bailout is coming to an end. On March 11th, the Fed Bank Term Funding Program ends, which means no more opportunity to just call up, hey, Jay, I've got some pile of dog crap here. It's worth about $10, but the original balance said it was worth $100. Will you lend me $100 and I'll hand you this pile of dog crap in exchange for that $100? And then between now and March 11th, the answer is going to be absolutely. Here's your $100 for your pile of dog crap. What? Yeah, taxpayers backing that, by the way. Okay, fine. March 12th. Hey, Jay, I got a pile of dog poop worth $10. Will you lend me any money? No, F off. What's that going to do to banks? I'm not saying we need to be here to bail out banks. I'm just saying I think bank crisis number 2 is around the corner, especially with the ending of the Bank Term Funding Program on March 11th, which I think will substantially increase the odds of the Fed cutting soon, not because they want to or because they're 100% convinced inflation is over, but because they're going to need to. This is scary. If you like my perspectives on building your wealth, we have a coupon expiring tonight on the programs on building your wealth. Go to meetkevin.com to see them. Stocks and psychology of money with trade alerts, 0 to millionaire, real estate investing, do-it-yourself property management, how to make money with AI, entrepreneurship, productivity, you name it. The gold course, by the way, which is not on the gold, the asset, but the gold course was filmed all in Q4 2023, in case you're wondering for where some of the latest is, although all of the...
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than House Act, nor am I presently acting as a market maker.